Most people buy government bonds for certainty. You invest your capital with the expectation of a strict, predictable schedule of payments. However, those fixed returns face a specific threat. Inflation silently reduces the actual value of the money you receive over time. If you hold a bond paying a 3% return while the cost of living rises by 5%, your wealth is effectively shrinking by 2% every year. In terms of actual purchasing power, traditional fixed income is variable. It leaves your capital exposed to the shifting costs of the broader economy. In 1997, the U.S. Treasury introduced a specific tool to address this exposure: Treasury Inflation Protected Securities, or TIPS. That program has since scaled into a global market with $2.2 trillion currently outstanding. To provide protection at this scale, the Treasury adjusted the underlying math that governs how a bond's principal is calculated. A standard bond has a static principal. The initial investment remains unchanged until maturity. A TIPS bond uses a dynamic principal. This adjustment is tied directly to the U.S. Consumer Price Index, the government's official measure of what goods and services actually cost. As the Consumer Price Index records rising prices, the TIPS bond principal increases in tandem. The fixed interest rate is then applied to this enlarged principal. Therefore, the actual cash payout grows larger as prices rise. Because the government requires time to collect and release cost of living data, these adjustments follow the index with a 3-month lag. This mechanical link ensures that an investor's cash flow keeps pace with the eroding effects of rising consumer prices. But the broader economy can also contract unexpectedly. What happens to these mechanics if consumer prices actually fall? In a deflationary environment, the math reverses. The TIPS principal mechanically decreases alongside the falling price index. To prevent a total loss of initial capital, TIPS include a structural safety net called the embedded floor. At maturity, the Treasury guarantees you will receive whichever is larger, the inflation-adjusted principal or the original amount you invested on day one. This provides a floor against deflationary shocks while capturing the upside of inflation, neutralizing the two primary threats to a bond's purchasing power. At a scale of $2 trillion, these individual hedges aggregate into a powerful macroeconomic indicator. We can calculate this by looking at a nominal bond's yield, which is simply the sum of expected inflation plus a real yield. This diagram deconstructs a nominal yield to show where inflation components hide. Subtracting a TIPS real yield from a nominal treasury isolates the market's inflation forecast. This gap, the break-even inflation rate, is the level required for identical returns. If a nominal bond yields 4% and a TIPS bond yields 1.5%, the market is effectively pricing in an expected inflation rate of 2.5%. This calculation changes TIPS from a simple portfolio hedge into a precise metric for reading the entire economy. This break-even rate updates every trading day, providing a real-time record of how global investors view the future of prices. Major policymaking bodies, including the Federal Reserve, use this specific data point to help determine when to raise or lower interest rates. This data is trusted because it is not a survey. It represents trillions of actual dollars being actively risked on the open market. The same mechanics used to preserve an individual's wealth now operate as a global sensor, providing the most accurate read on where the market thinks prices are headed.